This is the November 2019 Emerging Markets Forecast. And before I begin with a comparative analysis of the three major market ETFs, I wanted to discuss a little bit from the November opening statement. The opening statement from the Intelligent Investor, that is part one. You can go ahead and read. I'm just going to point out a few things, mainly in the bold text. I wanted to remind everyone that we have been talking about for several months now our view that earnings would not recover in the second half of 2019 to the extent that was estimated by Wall Street analysts and corporate executives. And that's precisely what we're seeing now. And I wanted to point that out because it highlights the value and the importance of understanding the big picture in order to plan your investment strategy and to foresee things down the road. And I'm going to show you an example of that here shortly when we talk about the IMF and their blunders. So it looks like we're going to see this third consecutive quarter of earnings declines, adding to the earnings recession. We're going to see a slight decline in Q3. But the earnings recession that we have seen in 2019 has been minor compared to that which we saw in 2015 and through the second quarter of 2016. In addition, keep in mind that the earnings growth that we experienced in 2018 was tremendous. We had not seen anything like that since 2010, over 20%. And keep in mind, the growth that we saw in 2010 was, to a large degree, first of all, was due to the banking bailout, the economic stimulus, right? In addition to that, the recoil effect. Recoil in terms of having collapsed, and then of course you're going to have a normal bounce. So the growth that we saw in 2018 was very strong and has helped to buoy the market despite the fact that we've had an earnings recession in 2019. But also it's been a mild earnings recession. And of course we're seeing decreasing rates this year as well, which has also helped. Keep in mind that we're in an environment of increasing global weakness, and we have the trade uncertainty, but the market remains strong. Even now we're seeing impeachment hearings begin. So given everything, I think it's pretty remarkable how strong the market remains. And I want to emphasize that because we remain, once again, in a bull market, a strong bull market. It may not look that strong, but it is when you factor in all of the things that it's had to deal with, right? I wanted to emphasize that at the same time, of course, we are approaching the final stages of the bull market, and it's becoming a little more difficult to see because of the artificial manipulation by the Fed. That is to say, lowering interest rates without really having the sufficient data to back that. I also wanted to mention, of course, now that the Fed has lowered rates for the third consecutive time as of October 30th, Powell, in my mind, officially has lost all credibility. And the important thing behind that is that it's going to become more difficult now to predict what the Fed's going to do. I've mentioned in the past that there's a difference between what happens versus what should happen. And the Fed increasingly is getting to the situation whereby they're not acting like they should. The problem with that is that it's more of a random behavior. So if the Fed acts as it should, assuming that our forecasts, our assessment of the economy is accurate, then it becomes pretty easy to predict interest rates. But if the Fed begins to act based upon other variables, it becomes very difficult because they may not consistently act in opposition to the economic data. So I want to point that out. And of course, this mainly applies to investor sentiment. It becomes difficult for investors to predict what the Fed's going to do, although they may be assuming that the Fed's going to basically answer their beck and call, right? They're going to appease the market, which may not be the case down the road. So I wanted to point that out. And then, of course, the IMF. IMF lowered its global growth estimates for 2019-2020, 3.2% to 3.0 for 2019. But the main point I wanted to mention is, of course, that in the past 12 months, IMF lowered its 2019 global growth from 3.7 to 3. That's huge. They blew it. I pointed this out several months ago, how the IMF was missing everything. They weren't factoring in the full impact of trade. And in the past, I've also mentioned why I even follow the IMF. And the reason being, and this is what not many people know this outside of the investment world. In fact, many fairly tenured investment professionals don't even know this unless they happen to be analysts. And that is the fact that virtually every research body goes by the IMF. They use the IMF data at least as a benchmark, a basis by which to customize their own estimates for economic growth and many other metrics. The starting point is IMF data because they have the greatest access to economic data. They have thousands of analysts and economists. So if the IMF misses everything, then it's going to automatically, generally speaking, not always, some firms might do a better job, but generally it's going to automatically skew the estimates of Wall Street, of corporate America, of government bodies. And you can think of this, if you go back to 12 years ago, 13 years ago, when the Federal Reserve, which by the way is also connected to the IMF, Wall Street goes by their data as well, the Fed and the IMF, they work together. All these bodies, they determine the basic foundation of economic data. If you look back to the Fed 12, 13 years ago, they missed the financial crisis. They didn't have a clue what was going on. The IMF completely missed the financial crisis. They didn't have a clue what was going on. And Wall Street missed it. Now you're starting to see why I look at the IMF, because it gives me a look at sentiment, what everyone else is thinking. And I've gone over the IMF many times. I've written about it. I've made videos. You may want to go through the articles and see how they've been wrong. The Fed, the same thing. So once again, it's important to not only have a good sense of what is going to happen, but also what everyone else thinks is going to happen, right? Because if we think something's going to happen and we're right, it doesn't matter. We don't move the markets. We're just a few people, right? What matters is to understand the reality and to know what everyone else is thinking, and then you can respond based upon that. So let me go ahead and give you an example whereby corporate America uses IMF data, IMF estimates, and we can see the implications of that. So I have here a screenshot of a recent article on Alcoa. Alcoa, of course, announced earnings. Disappointed, I believe they reported an EPS of negative 44 cents versus the street estimate consensus of negative or minus 33 cents per share. But the point is that if you read this article, if you read the red down below what I wrote, go ahead and do that. But you can see in paragraph 3, whereby Alcoa forecast, they downwardly revised their outlook for global demand for aluminum. They made this revision a day after the IMF came out with their latest World Economic Outlook update. My point is that this was no coincidence, folks. Alcoa, the management of Alcoa, waited for the IMF, and they came out the following day and revised their data, their estimate for world demand for aluminum based upon that. And then they announced restructuring plans. Now, obviously, Alcoa didn't just come up with restructuring plans after the IMF data. Clearly, they were discussing restructuring for several months. And those of you who get the Intelligent Investor, it should make sense because I've been talking about problems with Alcoa due to the decreasing demand, global demand for aluminum as a result of the weakening in the economy. So this should come as no news. My point, though, is that you have corporate executives relying on the IMF data, right? So think about now, if you look at the research, the securities research, part 1 of the Intelligent Investor, over the past several months, we've been guiding down for reentry because of the risk. We knew what was going on. because we had a good sense as to what global growth might look like because of the trade uncertainty, unlike the IMF. So I wanted to point that out.